Okay. This week, we are also learning about the statement of cash flows. So thus far, we've primarily focused on the income statement and the balance sheet. However, the statement of cash flow is also one of our general purpose financial statements that is reported in a company's annual report. You're going to have the income statements, some sort of statement of equity, the balance sheet, and the statement of cash flows. Now, you may be thinking, well, can't we just look at the balance sheet and see how cash flows have changed? We can. We can look at the balance sheet and we can see the beginning balance of cash and we can see the ending balance of cash. However, what the balance sheet does not tell us is why or how the cash changed. You just know it changed. So this is what the statement of cash flows will tell us. It will tell us how cash moved back and forth within the organization throughout the financial period. Okay, so in order to make this statement optimally useful to financial statement readers, cash flows are divided into 3 categories: operating activities, investing activities, and financing activities. Okay? Operating activities are those cash flows related to a company's core business operations. Okay? Inflows are primarily going to be from revenues. It's going to be, revenues in exchange for cash, or it is going to be the collection of accounts receivable associated with revenues. It's basically, operating activities are the revenues and the cost associated with doing whatever we are in business to do. Okay, core business activities. Investing activities. Investing activities are primarily focused on a company's long-term assets. Okay, this could be the purchase and sale of actual investments, or it could be the purchase and sale of fixed assets like property, plant, and equipment, those revenue-generating assets that we use in our operations. Those are the things that we see in investing activities. And financing activities are primarily the transactions that affect long-term debt and equity, okay? So these are going to be things related to the issuance of long-term debt, the repayment of long-term debt, the payment of dividends, stock issuance. These are the types of things that will be in financing activities, okay? And here they provide you some additional examples as well. Again, operating, just think of the company's core business, whatever they're in business to do. They're going to get money from selling their goods and services, and they're going to have cost associated with operations. Okay, they're going to have general expenses. Normally, the things that we see here are going to be related to changes in working capital. As you'll learn when we use the indirect method, which is the most commonly used method to prepare the statement of cash flows, we make adjustment for changes in working capital. That's changes in our current assets and current liabilities, because those are normally our operational accounts. Changes in accounts receivable, changes in inventories, changes in accounts payable. These are all related to our primary business operations. Again, investing, this is gonna deal with investments in property, plant, and equipment, buying and selling, financing, think long-term debt and equity. Okay. Now, again, you're going to learn about 2 methods for preparing the statement of cash flows. We have the direct method and the indirect method. Here's what I'll say about the direct method. Okay, the direct method is the one preferred by the FASB. Okay, the FASB has actually indicated a preference for the direct method. However, this is one of those strange situations where the vast majority of companies do not report based on the FASB's preference. In fact, I believe it's something like 98 or 99% of large public companies use the indirect method. Okay, now here's what I want to emphasize. The only difference between the direct method and the indirect method is the operating section. Okay, the investing section and the financing section looks exactly the same under both methods. And in terms of the operating activities section, the bottom line will be the same regardless of which method we use. It really comes down to the level of detail in our approach. With the direct method, we detail every source of cash and every use of cash. With the indirect method, we take, as you might imagine, a little bit of an indirect approach in that we start with net income and then we reconcile back to our operating cash flows, okay? So we start with net income, we adjust for any non-cash items, and we adjust for the changes in our working capital accounts. That's our current assets and our current liabilities. And this allows us to calculate the net cash flow from operations. So I think one of the advantages here is a lot of people, a lot of financial statement readers do actually like to see that reconciliation between net income and operating cash flows. And then it's also a little bit easier and less costly for the companies to prepare. So again, in your book, you'll learn how to use both methods. The direct method is preferred by the FASB, but most companies report using the indirect method. Okay, and this is a very simple example. In reality, it looks much more detailed when you see it, but this is a very simple example. Again, under the direct method, we are going to list every single line item for cash received and cash paid. Under the indirect method, we start with net income, and this is an easy way to tell. If you're ever looking at a statement of cash flow and you're thinking, wow, I can't tell which method they use, look at the first line in the operating section. If it says something to the effect of net income, net loss, net earnings, net profit, if it says anything to the effect of that, that is instantly, you're looking at the indirect method, okay? The direct method does not start with income or profits or anything like that. It is nothing but cash received and cash paid. So the indirect method starts with net income, and then again, we're going to adjust for the changes in working capital accounts. We will also adjust for non-cash items, and that will allow us to calculate the net cash flow from operating activities. Now again, assuming that it's done correctly, the net cash flow from operating activities will be exactly the same regardless of which method we use. And again, the section on investing activities and the section on financing activities is exactly the same under both methods. So nothing changes there. Only the operating section will look different. All right. So this is a more detailed example of what it looks like when we use the indirect method on the operating section of the statement of cash flows. And you should be able to find this graphic in your book. Here they give a specific listing of things that are subtracted and added, okay? And I can tell you that it would be a lot to memorize. So this is an area where I always tell students, I want you to really learn to think about these things, and if you can learn to think about it, you can use common sense to figure out how it affects cash, okay? So as an example, let's think about accounts receivable together, okay? Well, let's think about what accounts receivable represents. Accounts receivable represents customers who owe us money, all right? Well, if accounts receivable increases, that means that fewer people have paid their bills to us, okay? Fewer customers are paying us. If fewer customers pay us, does that have a positive or a negative effect on cash flow? Well, if fewer people are paying us, that's a negative, right? That's why it's subtracted, okay? We use the same logic over here. A decrease in accounts receivable means more customers are paying us. Well, if more customers are paying us, that has a positive effect on cash flow. So we're going to add that, okay? And that's kind of the logic that you have to use on each of these. You have to really think about the account and think about how does this change affect us from a cash flow perspective, okay? Now, if you still think that's a little bit confusing, then you could just bookmark this graphic in your textbook, and you can refer back to it as you're working on the problems. You can always feel free to refer back or make some notes or something that you can kind of refer back to. But I think it just helps to learn to really think about the accounts critically and think about the effect that they have on cash flow.